All right. Hello, everyone, and a huge welcome, especially to all you exam aspirants out there. Now, you already know that NBFCs are a massive topic. Today, we're going to break down the RBI's scale based regulation, a framework that is completely changing the game for India's shadow banking sector. Let's get you ready for that exam.
Okay, so here's our game plan. We're going to kick things off with the why. What problem was the RBI even trying to solve? Then we'll unpack their solution, this new four-layer pyramid structure. After that, we'll dive into the nitty-gritty of the rule changes and wrap it all up with a super focused summary of everything you need to remember. Let's get into it.
So, first things first. Before we get lost in the details of all the new rules, we really need to get the big picture. Why the big change? What pushed the Reserve Bank of India to overhaul the entire system like this? Let's set the stage. And here are the core reasons, plain and simple. The NBFC sector didn't just grow, it absolutely exploded in size. Their business got way more complex. And here's the crucial part. They became deeply interconnected with the rest of the financial system, with our banks, with the markets. Put all that together, and it means their systemic significance shot through the roof. The old one-size-fits-all rulebook just couldn't handle that kind of risk anymore. So what was the RBI's big idea? Well, they came up with something much smarter, a more tailored approach called scale-based regulation, or SBR. The easiest way to picture it is as a pyramid. Basically, the bigger and riskier an NBFC is, the higher up the pyramid it sits, and the stricter the rules get. And here it is, the pyramid in all its glory. Down at the bottom, you've got the base layer, or NBFCBL. These are the guys with the lightest touch regulation. But as you climb up to the middle layer and the upper layer, whoa, the rules get much, much tougher. And right at the peak is the top layer, which is kept for any company that becomes so important that its failure could shake the whole system. Simple, right? The bigger your shadow, the brighter the spotlight on you. This table really helps make it concrete. You can see how different types of NBFCs are slotted in. Notice the smaller, less risky players like peer-to-peer lenders are chilling in the base layer. But the moment an NBFC takes public deposits or is a major housing finance company, boom, it's automatically in the middle layer. The upper layer is basically the top 10 biggest NBFCs, and the top layer, well, the goal is for that to stay empty. It's like a break glass in case of emergency category. And for all you exam takers, here's a little trick to lock this in. Just think of the acronym BMUT to remember the order: base, middle, upper, and top. It's pretty handy because the whole point of this system is to mute those big systemic risks we were talking about. All right, now that we've got the structure down, let's get into the specifics. What are the big rule changes that are hitting these NBFCs? The next few points are absolutely critical, so definitely pay close attention here. First up, a very important number, the minimum net owned fund, or NOF, which is basically their core capital, has been hiked up in a big way for key players like investment and credit companies and microfinance institutions. We're talking about a jump from 2 or 5 crores all the way up to 10 crore rupees. That's a huge step to make sure they're better capitalized from day one. Now, the RBI knows you can't just flip a switch on this, so they've laid out what they call a glide path. As you can see, it's basically a phased timeline, giving existing companies all the way until March 2027 to build up their capital and meet this new 10 crore requirement. Okay, this next one is a really big deal. The definition of a non-performing asset, an NPA, has now been standardized across the board. For every single NBFC, a loan is now officially an NPA if it's overdue by more than 90 days. This is so important because it puts everyone on a level playing field with the banks and gives us a much clearer picture of the real health of the financial sector. And just like the capital requirements, they're not asking everyone to change overnight. There's a glide path for this too, especially for the smaller guys in the base layer. They have until March of 2026 to gradually tighten their belts and move to this stricter 90-day NPA standard. Here's another number to file away. There's a new cap, a ceiling of 1 crore rupees per borrower when it comes to financing IPO subscriptions. So what's this about? It's really aimed at putting the brakes on too much speculative borrowing funded by NBFCs during IPO frenzy. Okay, time to climb higher up the pyramid. For the really big, systemically important NBFCs, the ones in the middle and upper layers, this is where things get really serious. The regulations start looking a lot more like the tough rules that our commercial banks have to follow. First up is this concept called ICAP, That stands for Internal Capital Adequacy Assessment Process. In simple terms, the RBI is basically saying to these big NBFCs, look, our minimum capital rules are just the starting line. You need to build your own robust internal system to constantly check all your unique risks and prove to us and yourselves that you have enough capital to handle a crisis. It's about owning your risk, not just taking a box. Now, this slide shows a super important before and after. Look at the old way on the left. They had separate limits for lending and investing based on a broad measure of capital. Now, look at the new way on the right. It's simpler and way stricter. There's now a single exposure limit, no more funny business, and the really critical part, it's based on high-quality Tier 1 capital. The new ceilings are 25% to a single company and 40% to a group of related companies. Much tighter control. And for the absolute top dogs, the ones in the upper layer, the RBI is rolling out the Large Exposure Framework, or LEF. Again, this is another huge step that brings them almost on par with banks, forcing them to have a very sophisticated system for managing the risk of having too many eggs in one basket. And here is a number that those upper layer NBFCs have to live by. They now must maintain a minimum common equity Tier 1 capital, or CET1, of at least 9%. Now, CET1 is the best of the best, most loss-absorbing capital you can have. So demanding a 9% minimum is basically forcing them to build a much stronger financial shock absorber. All right, we're in the home stretch. Let's quickly look at how these big players actually move into the stricter layers, and then let's pull everything together into a rapid-fire exam-focused summary. This is your ultimate revision guide. So how does an NBFC get moved up to the upper layer? Well, it's not random. It's a very clear three-step process. First, the RBI taps them on the shoulder and officially lets them know. Second, the company's board gets just 3 months to come up with a solid plan to comply. And third, they have a maximum of 24 months, that's 2 years, to get everything in order and follow all the new, tougher rules. Okay, let's consolidate. Time for a rapid recap of the key concepts. These are your absolute must-knows. SBR, that's the 4-layer pyramid. NOF, the new minimum capital, remember 10 crores. ICAP, the internal self-assessment for risk. LEF, the framework for managing big exposures. And CET1, the high-quality capital with that 9% minimum for the big guys. Got it? Good. And now for the numbers. If you walk into your exam, these figures absolutely have to be at your fingertips. The 1,000 crore asset size that separates the base and middle layers, the 10 crore new NEOF, the 90-day NPA rule, the 1 crore IPO financing cap, the 25 and 40% exposure limits, and finally that 9% CET1 requirement. These are prime questions right here. So if you zoom all the way out, what's the big story here? What are the core changes? This slide nails it. You've got the structural shift to the 4-layer framework. You have serious prudential tightening with those capital and NPA rules. There's a much sharper governance focus. And of course, the big one, the move towards bank-like regulation for the largest, most important players. That's the entire strategy in a nutshell. And that leaves us with one final big question to think about. This new framework is smart. It's layered, it's forward-thinking. But is this new regulatory pyramid truly the silver bullet? Will it be enough to make India's incredibly important shadow banking sector genuinely shockproof for whatever the future throws at it? Well, only time will tell.